You've probably seen the headlines by now. Words like global gold reset, fatal blow, and end of the LBMA. Some channels are framing this as an overnight collapse of the Western gold market driven by a Russia-China deal that's about to rewrite the entire system. If you've been watching this space for a while, you already know my stance on headlines like that. They're designed to provoke a reaction, not provide clarity. Today, I want to slow this down, strip away the hype, and look at what's actually happening, what isn't happening, and what the data really says. This is Financial Briefing, and if you're new here, my goal is simple. Calm, accountable analysis that helps you think clearly about risk, not chase narratives. Before we get into the data, let me ground this discussion in some accountability. About 18 months ago, when gold first broke above $2,000, I said it was more likely to consolidate than explode straight to $3,000. Gold chopped sideways for nearly 9 months after that call. Last summer, when silver spiked into the mid-30s, I said the risk-reward favored a pullback before a sustainable move higher. We saw silver retrace into the high 20s before stabilizing. And late last year, when some analysts were calling for an imminent dollar collapse, I said the dollar index was more likely to remain range-bound, given yield differentials. The dollar stayed firm for most of the following quarter. I mention this not to claim perfection, but to remind you that this channel tracks calls, revisits them, and adjusts when the facts change. Now, let's talk about what's driving the current narrative. The first data point is central bank gold accumulation, specifically from China and Russia. According to publicly reported figures, China added roughly 225 metric tons of gold to its reserves over the past 12 months. Russia, despite sanctions and limited reporting, is estimated to have added between 70 and 100 tons through domestic production absorption. Historically, that matters. In the decade before 2014, China averaged closer to 30 to 40 tons per year. Russia averaged around 150 tons, but that was during a period of explicit de-dollarization policy. The context here is that these additions are elevated but not unprecedented. What it means is that large state actors continue to treat gold as a strategic reserve asset, especially in a more fragmented geopolitical environment. What it does not mean is that they are about to reset the global gold price or suddenly invalidate Western markets. Central banks buy gold quietly, steadily, and for balance sheet resilience, not for headline shock. The second data point is settlement behavior outside traditional Western bullion hubs. There's been an increase in bilateral trade settlement using local currencies between China, Russia, and several commodity exporting nations. Estimates suggest that roughly 20 to 25% of Russia-China trade now avoids the dollar entirely. Historically, that's significant because 10 years ago that number was in the single digits. The context is a gradual diversification away from dollar settlement, driven by sanctions risk and political alignment. What it means is that the dollar's share of marginal trade flows is slowly declining in certain corridors. What it does not mean is that the dollar is being replaced by gold in trade settlement. These agreements still rely on currency swaps, banking infrastructure, and trust frameworks. Gold is a reserve asset in the background, not the unit of account at the transaction level. The third data point is the structure and credibility of the LBMA itself. London remains the largest over-the-counter gold market in the world, clearing an estimated 18 to 20 million ounces per day. Even during periods of stress, such as March 2020, settlement continued, albeit with logistical strain. The context here is that physical delivery demand has increased relative to paper claims, particularly from Asian buyers. What it means is that Western bullion markets are under pressure to improve transparency and inventory management. What it does not mean is that the LBMA is insolvent or on the brink of collapse. A fatal blow implies a single point of failure. This is a complex, deeply capitalized system with multiple redundancies. So let's talk about the bullish case, because there is one. First, continued central bank accumulation could tighten the physical market over time, especially if mine supply growth remains constrained at roughly 1 to 2% annually. Second, geopolitical fragmentation increases the appeal of neutral reserve assets like gold, particularly for countries seeking to reduce exposure to sanctions. Third, if Western investors re-engage with gold as a portfolio hedge during an economic slowdown, you could see a synchronized demand impulse. Fourth, structural distrust between East and West could lead to parallel pricing centers, creating inefficiencies that benefit physical holders. If all of those line up, I see a bullish outcome with perhaps a 25% probability. Now the bear case. First, central bank buying is lumpy and politically driven. It can slow or stop without warning. Second, Western financial dominance isn't challenged overnight. Liquidity, legal frameworks, and trust still favor London and New York. Third, higher real yields remain a headwind for non-yielding assets like gold. Fourth, many of these headlines conflate long-term strategic shifts with short-term price action. This narrative could fizzle as markets refocus on growth and rates. I assign roughly a 35% probability to this more muted outcome. Which brings us to the middle case, and this is where I land. The most likely scenario is a gradual, uneven evolution of the gold market. Eastern demand continues to grow. Western markets adapt rather than collapse. Gold remains bid, but not parabolic. Think higher lows, periodic volatility, and no dramatic reset moment. This isn't a revolution, it's an adjustment. I put a 40% probability on this path. For historical context, I often look back to the breakdown of Bretton Woods in the early 1970s. There are similarities: rising geopolitical tension, questions about dollar convertibility, and renewed interest in gold. But the differences are critical. Back then, gold was directly linked to the monetary system. Today, it's a reserve asset operating alongside fiat currencies, not replacing them. The transition now is slower, more decentralized, and less binary. Cross-market signals reinforce that view. Gold prices have been firm but not disorderly. The dollar index remains elevated relative to its long-term average, suggesting no immediate confidence crisis. The 10-year yield is volatile but not collapsing, indicating that bond markets aren't pricing in systemic failure. Taken together, these markets are signaling adjustment, not rupture. Positioning data supports caution. Commitment of traders reports show managed money holding moderate net long positions in gold, well below historical extremes. Banks are largely market neutral, suggesting no panic or exuberance. Institutions appear to be treating gold as insurance, not a speculative bet. So here's my action plan. And remember, this is not advice, just my framework. If gold breaks and holds above its recent highs on rising physical premiums, I add incrementally up to a maximum allocation of 15% of my portfolio. If gold rolls over and real yields rise sharply, I reduce back toward 10%. Currently, I'm allocated 12% to gold, 3% to silver. My stop loss on new additions sits about 8% below entry. My first take profit zone is 20% above, where I reassess rather than automatically sell. What am I not doing? I'm not panic buying on headlines. I'm not binge watching fear-based content that frames every development as an existential threat. And I'm not assuming the collapse of the global financial system is a base case. This week, I'm watching three things. First, physical premiums in Shanghai versus London. A widening spread would be bullish, convergence would be neutral. Second, central bank commentary around reserve policy. Explicit references to gold accumulation would be supportive. Silence isn't bearish, just status quo. Third, real yields. A sustained move lower would favor gold. Higher yields would cap upside. Let me wrap this up. 1, there is no overnight global gold reset. 2, Eastern accumulation is real but gradual. 3, Western markets are adapting, not dying. 4, gold remains a strategic asset, not a get-rich-quick trade. If this kind of measured, data-driven analysis helps you think more clearly, consider subscribing. This is Financial Briefing. Stay sharp.